Hello everyone, John Flynn here from Flynn Real Estate in Niagara Falls, serving Southern Ontario, specifically Hamilton and Niagara region. Today we have a couple of things to talk about. We're going to talk about the Bank of Canada's interest rate hike last week, and it went up 0.5%. This is the biggest rate hike, as you may or may not have heard, in the last 22 years since the year 2000. They haven't put it up more than 0.25% each time, so that's interesting. And of course, we're going to go through the statement, and we're going to get into the mid-month statistics, which obviously you know from the thumbnail, they're trending down, but we're going to get into specifics. So let's get right into this, the Bank of Canada rate hike. So in the announcement from the Bank of Canada with regards to the rate hike and the reasons for doing it, they mentioned, of course, the war many times, and everyone likes to blame the pandemic and the war for things. It's not that it doesn't affect things, it does, but it was mentioned a good few times in this. And I'm not saying he's trying to put the blame on it, but of course there is a little bit of blame there for certain markets and certain policies. So here I highlighted some key points. Let's go through them and I'll give you my take on them. The war has also introduced a major new source of uncertainty to the global outlook, and it is boosting already high inflation in many countries, including Canada. So kind of boosting the already high inflation. So already high, but it's boosting it. So you got to read between the lines here. And there's, again, three things in this policy announcement. The first is the Canadian economy is strong. Overall, the economy has fully recovered from the pandemic and is now moving into excess demand. So we want to buy too much. But during the pandemic, I think we bought a lot too. But anyway, we're going to excess demand, not high demand, right? Second, inflation is too high. It is even higher than we expected, and it's going to be elevated for longer than we previously thought. It's, of course, no transitory inflation like they said in the past, especially in the States, they said that. Third, and most importantly, in my opinion, we need higher interest rates. Our policy interest rate is our primary tool to keep the economy in balance and bring inflation back to the 2% target. This morning we raised our policy rate by 50 basis points to 1%, and we indicated Canadians should expect further increases. All right, and we go through, and he talks about reasons, and I'll put the link in the description. You can read it yourself. It's actually a little bit more lengthy, not much more, but than the usual ones, because it is a 0.5%, and they have to justify it. So here we get to the housing, a little bit on housing. Housing activity has remained strong and is expected to moderate, but to still elevated levels. So again, it goes back to, I say the market went from insane to very good. When we say it's slowing, we don't mean it's crashing. It could crash in the future, but it is definitely slowing from an insane market, if you want to use my wording, to a very good market. So here they kind of changed their tune when it comes to Canada. In the first paragraph, it was different, kind of a little bit of blame on it for excess inflation. We already have inflation, but it's adding to it. The impact of war on growth in Canada is likely to be small for two reasons, and he cites a couple of reasons. So again, it's not really impacting us, the war, because we have lots of oil and grains and things like that. So finally, we discussed the impact of increasing our policy interest rate. While we have been clear that Canadians should expect a rising path for interest rates, seeing their mortgage payments and other borrowing costs increase can be worrying. We will be assessing the impacts of higher interest rates on the economy carefully. So he's acknowledging it's going to be worrying, or it is worrying for Canadians. Canadians should expect interest rates to continue to rise toward more normal settings. By more normal, we mean within the range we consider a neutral state for interest rates that neither stimulates nor weighs on the economy. The neutral interest rate isn't something we can measure directly. We have to estimate it. And our estimate is between 2 and 3%. Today we raised the policy rate to 1%, still well below neutral. It is also well below pre-pandemic policy rate of 1.75%. It is important to remember that we have an inflation target, not an interest rate target. So it's interesting that they said that it's not an interest rate target, and he does mention that it could go above that neutral rate of 2 to 3%. It could go, and this is the Bank of Canada, not mortgage rates. Mortgage rates are obviously higher than the Bank of Canada rates. And here, this is where he addresses the point I just made. We may need to take rates modestly above neutral for a period to bring demand and supply back into balance and inflation back to target. So above that 2 to 3%. So he's saying it's not out of the question to raise like the overnight lending rate, the Bank of Canada rate, to higher than 3%, which would mean if they were higher than that, you're looking at, I'm just gonna take a wild guess, like 6% plus for 5-year fixed mortgages, and the variable rate would be, closer to 4.5%, 5%. But yeah, that's not out of the question, right? Because they have to tackle this inflation. And lastly, back to quantitative tightening. Let me conclude with a brief word on quantitative tightening. We expanded our balance sheet during the pandemic, first to help restore financial market functioning and provide liquidity to the financial system, and then to add further stimulus to support recovery. Last November, we stopped increasing our holdings of the Government of Canada bonds and have been in the reinvestment phase since then. Today, we announced that we are entering the next phase, quantitative tightening, or QT, effective April 25th. We will stop purchasing Government of Canada bonds to replace our holdings as they mature, so our balance sheet will shrink. This will put upward pressure on borrowing costs further out on the yield curve, complementing the increases to our policy interest rate. So that last bit, complementing the increases to our policy interest rate. So interest rates are going up further, and of course the yield curve, yield is what your return on investment for debt, for bonds. So that's going to complement their increases to the policy interest rate. So QT has started happening, but the 25th of April, there's going to be less from the Bank of Canada again. We've already gone through phase 1. This is phase 2. So less money in the system from the Bank of Canada, less money printing, hopefully, and we'll see where that goes. So anyway, that's the Bank of Canada, and that's what they had to say to justify their interest rate hike. Let's just take a quick look at how it affected the mortgage rates from the Big Five again. You can see in the middle column, the 5-year fixed, it didn't really move much. We're still at 3.99 from the highest from the major five now, but the rest are still they've tightened up to 3.82 now, CIBC, that they were like 3.6 something maybe a week ago. So that didn't really affect the 5-year fix so much, but it'll be interesting to see who breaks that 4% bracket first. It did directly affect the variable rates because they're more closely related to the overnight lending rate, and they all went up pretty much a 0.5% as to reflect what they did in the policy rate, a 0.5% increase. So that's directly and indirectly on the fixed, but the fixed, you'll see it move now in another few weeks when they're anticipating the next rate hike. Okay, so now let's get into the stats, like what's happening in the market, how are these rate hikes affecting the market? There is a lag time, but we've already seen one, and this consumer sentiment change significantly, but we're going to quantify this with some numbers right now. The CREA, Canadian Real Estate Association, they have they have a lagging statistic, so they're only releasing their March numbers tomorrow. So I'm making this video today. So I'm going to put them on the screen now, and you can look at what they are. I don't know if you'll see any decreases or significant increases or decreases from this. You probably won't, because this is a national statistic, but here they are. Take what you want from it. Now, I have had some comments that, hey, can you include Toronto stats? I don't have access to the Toronto board. I can get it through friends and whatnot, but I'll give you a link to another guy, and you might have already seen him, Team Sessa, I think his name is. He does like weekly videos on specific regions in Toronto. I watch them, and it's trending the same way. He's a little more dramatic about his, which is fine. I like watching him. But here's the link to one of his videos, and then you could subscribe to his channel through that link. I do have some TREB or some Toronto numbers here, so let's check them out, and I will get into the rest of Ontario right after that. But let's check out Toronto real quick. So these again they don't have any April stats because April's not complete, and I can't pull partial or mid-month stats from the system because I don't have access to it. So, but anyway, Here was the total transactions year over year. So March 21 to March 22, we're down about 5,000 transactions from last year at the same time for March. And right on the right-hand side, you'll see it's from month to month. So from February to March this year, we're down 18.6%. So sales are down, and whether you're looking year over year or month to month, they're down in Toronto. Next, we have the average selling price. Of course, from March 21 to March 22, it's up 18.5%, obviously. But from February to March this year, it's down 1% approximately. All right, so here we have a snapshot of the listing activity. So total new listings are down 12% from last March to this March. And the sales to the new listings, so let's say for every 100 listings, you have 69 sales last year. So for every 100 listings this year, you have 55 sales. So you can take the inventory out of the equation there, right? Even if inventory was down, which it's not significantly, we have less sales per new listing. So we went from, it's just over 50%, 55%. So that's obviously shows a decline, right? I want to see what kind of a trend we're looking at. So here we have days on market, whether it's property days on market or listing days on market. We have, it's down. So this is a positive indicator. It's still taking less time to sell your house than it did last year in March. All right, now let's get into quickly our mid-month stats on my system. Now I talk about my system, and I'm just like everywhere besides Toronto. So here is a map of where the system that we share. It's called ITSO. All these boards we all share the same system, so we get information on it all. And it's pretty much, you can see all that blue, the aqua blue that surrounds Toronto, that green parts are Toronto, and the red part, or the whatever color you want to call that, is Hamilton, which we have a sharing agreement. They're not part of ITSO, but we have a sharing agreement, so we get all that data too. So when I'm talking about all of Ontario besides Toronto, this is what I'm talking about, and including Hamilton. So all the blue and that red area, or burgundy, or whatever you want to call it. So here it is. Here are all the areas and the percentages that they're up or down compared. So this is from the highs. This is from the all-time highs, which are all this year. Most of them are February and March. One of them actually was in January. I think it was Guelph or somewhere. But again, from the all-time highs, regardless of what year, they're all this year, to up for April, compared to April, all of the sales in April up to April 18th, and the average prices. So most areas are down, but I want to look at the major, or the more populated areas, because that kind of gives you, it's hard to say when you're up in North Bay that it's down 2%. Well, there's not many listings up there, and it's a different market. So Cambridge, down 9%. Next, Guelph. Guelph is a pretty populated area, down 4.4. Then we get into Kingston's not bad. It's 7.4, but it's not a huge area. Kitchener-Waterloo, very active area, lots of people, down 9.8. London, St. Thomas, pretty big city, 8.7. Niagara, I'm going to throw Niagara because that's my area, and we have over 500,000 people in the Niagara region, down 3.5. It's actually, that's pretty, it's one of the better ones, or I guess if you're a seller, it's one of the better ones. Mississauga, we get some listings, but majority of them would be on Toronto, but still they're down 4.6, but the TREB numbers might be different. Oakville, 9.2, Woodstock, 9.6, and then you have Hamilton, Burlington. Like I said, they have a sharing agreement. They're not part of ITSO, but we have all the information, full statistics, so they're down 5.1. So you can see there's a range, but most areas are down here significantly, and this is from within a month or two, depending on the area, from the all-time highs this year down to 18 days of April so far for the average prices. So collectively, those areas I showed you again, with all of the data I get on the ITSO, excluding Toronto, but all the rest of the areas, on average, they're down. All areas are down combined 8.3% from a February high. You can see on the graph, the average peak was in February, and it was just under 1 million, or 980 or whatever it was. And we're down 8.3% from those highs. And that's a lot of listings included. It's 100,000 over the last year, 12, 13 months. So you're looking at 10,000 listings a month or something, or 8 to 10,000. So we're down 8.3% from the all-time high. That's pretty significant, but you got to remember, we did go up, 12% in 1 month, 12 to 14, depending if you're looking at average or median. These are average, but we went up average 12% in 1 month from December to January. So down 8.3, it seems like a lot, but it's not in the big picture. Here's the close price to the original list price. It's, what are people getting? 100%, 200%? Well, not 200%, but all areas in Ontario, excluding Toronto, were down almost 10% from, we were selling at 120% of list price to 110%. Now you have to remember, a lot of those list prices were low to get multiple bids to drive up the price. So again, but it's still down. And the last time it was under 100% was the beginning of the pandemic, almost in July 2020. It was the last time it was actually under 100%. It was at 99.4. So we're still a very good market, right? There's no denying it, but it is changing, and it's changing rapidly. So that's my point of these videos. Just keep an eye on it. It's trending downwards. It's still very good, but just keep an eye. As I said, it's still a very good market. We're at 10 days on average, or 10 days on market on average to sell your house. So it's still a very good market. Like historically, you're looking at 40 to 60 days or something in that range. So we're still at very low days on market. And lastly, my last statistic here would be number of expired listings. So of course, as the market slows, you will see expiries come on the market more. And again, this is from all the areas I mentioned before. We do have the expired listings starting to creep back up, but they're still like at near all-time lows for expiries. But again, just part of the trend that we're seeing. This makes sense. So yeah, there you have it. We are in a downtrend, going from, like I said, insanely good market to a very good market. But it is happening quickly. So when will that go under 100% of listing price to sale price, or sale price to listing price? That's a big indicator. Months of inventory is a big one, which I don't have yet until after the month is over for an accurate reading on it. A lot of the statistics I can't get mid-month because number of sales, say, you can't do, right? We still need the rest of April to get the actual number of sales to give that. So we are trending down. Prices have reversed. That's clear, and I'll stick behind that. The only way they're going to go back the opposite way is if Tiff Macklem of the Bank of Canada drops their interest rate back down, which it doesn't look like they're doing because of inflation. Keep an eye on the inflation, because we're going to come out with the numbers very shortly. I think it's the 21st or the 20th of this month. So in a few days, we're going to have the inflation for Canada. The States was up to like 8.5%. We're going to probably, the Bank of Canada is actually, they're calling for 6% for the first half of this year. So it's not going to go down, inflation. They're expecting it to keep going. So keep an eye on that. Let me know what you think from what you've heard today. I do get some comments saying like prices will never go down, and maybe it's relative. Maybe they're saying they'll never go down over time, but right now they are in a downtrend. So whether you're buying or selling, just keep that into consideration. One thing that you have to think about with the buyers especially, and the sellers have a lot to think about right now, but the buyers, are you going to buy? Is it worth you buying? Are you betting that these numbers are going to get worse? I think they probably will, but who knows how much. But at the same time, you have your interest rate hold. So a lot of the buyers still have their interest rates hold from 60 to 90 days. Now they're getting, just under 3%, maybe 2.89 on a fixed. Is it worth waiting to buy for reduced prices, but you're paying higher and higher interest rate, or are you going to buy now? So that's something that it's a tough decision for people, and I'm not going to say yay or nay because I can't predict what will happen. I'm just looking at trends. These are the trends. Comment below, let me know what you think, and as always, subscribe, share. Let's get these videos out there. I'll keep these statistics coming and my opinion coming. So yeah, thanks for watching, and I will see you next week.